What's up, guys? Bang, bang. This week was a wild one in Bitcoin. Let's get into these Bitcoin metrics brought to you by FTX US. Obviously, we've got Bitcoin just absolutely going sideways between a pretty big range over the last few weeks, but we're coming up on a 10th red weekly candle. Explain to people the significance of these red candles on the weekly charts.
Yeah, I mean, I just think it's kind of a fun fact that we've reached a record number of down candles, and everyone keeps saying, well, you know, we've got the 8th in a row. Certainly next week will be green. We've got the 9th in a row. Certainly next week will be green. And here we are with this nasty wick on the top side of the candle. And looks like we're currently, at least as we're speaking, in the 10th red week in a row. So pretty brutal price action and over the last few months.
All right. And then if you start to look at the importance of this, is it just something that traders look at, or should like regular Bitcoin holders who are just dollar cost averaging in or just hold Bitcoin to protect their economic value, should they care about this idea of like a 10-week losing streak? Like what's the significance of 10 weekly red candles?
I mean, I just think it goes to show you like how unprecedented the current price action has been relative to Bitcoin's history. And as we'll get to in a moment, you know, I think this is a great time to DCA into Bitcoin. We'll talk in a moment that, you know, we haven't reached full reset on a lot of these on-chain oscillators, as well as reached some of these technical levels, things like the Mayer multiple or the 200-week moving average. But we are, you know, very close to those and in the lower 10th or 25th percentile of all these on-chain metrics. I mean, which we've been saying for the last month or two, but it still holds true. I think for people who dollar cost average into this asset, this is the time where you want to be ramping up your DCA. And as I kind of put on Twitter a little while ago, I think this is a DCAer's paradise. And I think, you know, relative to Bitcoin's history, where Bitcoin's trading based off of just price action oriented things or also behavioral things shown by on-chain, I think we're at a great kind of area to average into for the long-term investor for sure.
All right. And then if we go ahead and we take a look at these lower timeframes and Bitcoin kind of being range bound, you've got a chart here that's showing us what looks like it's just trading within this band. What exactly are you pulling from this one?
Yeah, I really honestly just put this chart in here just to show like how horrendous this price action has been over the last like 2 or 3 weeks. We've just been in a range and it just is grabbing liquidity on both sides of it. So meaning like, you know, you fake out to the upside of the range, fake out below the bottom of the range. It's just not the type of trading that I find conducive in this environment. I think, you know, in this environment, you want to be building long-term positions and things that you're convicted in. Obviously for me, that's Bitcoin. But yeah, really just, you know, maybe if you have some type of, you know, real material edge and order flow or something like that on these lower timeframes, then that's different. But, you know, I think even for people that are just looking to play the range, that even really hasn't been that conducive because you've just seen price action faking out to both sides and trapping traders looking to trade the breakout of the range on both sides. So just pretty horrendous, ugly, choppy price action.
All right. And then you pointed out that the NASDAQ correlation with Bitcoin on the 1 day has finally decoupled, which I know is something that you've been pointing out, you know, kind of how high the correlation has been for a while now. Why do you think this is happening and what's the ramifications?
Yeah, sure. So, I mean, obviously, like you mentioned, we've been at a really high correlation to the NASDAQ. The 3-day correlation last week hit an all-time high. About a month or two ago, the 1 week correlation an all-time high. I mean, however, whatever time frame you want to look at, Bitcoin's been basketed by the broader market and with just, you know, the NASDAQ and tech stocks and just broader risk assets. So it's been interesting over the last week to see this decline. We are still kind of in this lower bound of where the correlation has been trading over the last few months. But it did get pretty low a few days ago. And it's funny because we've been talking about decorrelation, decoupling, all this stuff, right? And we got the decoupling, but it was in the opposite direction of what we would have liked to see, which is pretty funny. But I think what that kind of goes to show you is just the simple fact that like you had some unique flows coming from BTC, maybe fund redemptions or something like that. But yeah, it was pretty brutal for those 2 days. You know, you finally saw this decoupling, but it was stocks were rebounding and Bitcoin was kind of just like bleeding down. So nonetheless, though, I do like to see that we're kind of trading at this lower level of correlation, as Arthur Hayes put in his piece over the last few days. I think it was 2 days ago he published it. He was saying to him this is kind of a bottoming signal. I think you could definitely make the case for that, but nonetheless, I do like to see BTC trading on its own.
Got it. And then if all of a sudden we start looking at Bitcoin dominance, like how do you think about if the decoupling of the correlations occurs, then should we expect that to mean dominance is going up, or are these two completely unrelated?
Look, I think so. The way that historically the crypto market has worked is that in bull markets, well, I should start with the bear because it kind of gives you the base for the bull. So, in the bear market, people put their money into things that have real fundamental value. You're not just throwing money into, I don't know if I can curse on your dog shit, right? You're not throwing money into Shiba Inu and Dogecoin, right? So in the bear, you get this consolidation of liquidity into majors, primarily like BTC and ETH in 2018. And that allows you to kind of get this move into the bull run when you have properly allocated capital. And then as you head into that kind of area of exuberance in the bull, then you see the liquidity disperse into other assets. Obviously in 2021, the kind of darling, whatever crypto hedge fund trade was, the Solana, AVAX Alt One trade. And so what happens is you have all these new projects come into the space in a bull market. You get all this new talent that comes into the space building things. And what happens eventually is that the amount of new products that come into the space or projects outpaces the amount of capital inflows that are able to support all of that dispersion. And then those capital inflows just can't hold up the market. And then you get that liquidity flow back to BTC, and I should say majors, but in specifically BTC. And then that kind of starts the cycle all over again. So in 2018, we had this pretty clean kind of double bottom in kind of the mid to latter half of 2018. Now it looks like we're shaping some type of rounded bottom in BTC dominance, and it's now 19% off the lows. So now Bitcoin makes up about 47% of the total crypto market cap.
And then when we look, as this is playing out, we've got the ETFs continue to get inflows. You've included the Canadian Purpose Bitcoin Spot ETF. Is this just like price goes down and a certain subset of investors find that attractive? They were going to buy Bitcoin. Now they're more excited because it's cheaper than it was. And that's why the ETFs are getting the inflows, even though the price is going down because someone somewhere is selling. So like ETFs more serve as like a retail exposure.
I mean, look, I don't know, who is buying through the Purpose ETF and like what their intentions are. I mean, in theory, it would likely be the fact that the price has been declining. So people find an advantageous time to buy in. But nonetheless, like we have seen, and, that's all opinionated, but as to the facts are that the Canadian Purpose Bitcoin Spot ETF has seen an inflow of about 11,350 BTC in the last 30 days, which has been the most aggressive 30-day increase in its existence, which is pretty interesting to me. I mean, 11,000 BTC isn't going to bottom the market out or anything. I just do find it interesting that we've got, the largest spot ETF for BTC, and that's seen continuous inflows despite the downtrend over the last month or two.
All right. And then if we take a look at the on-chain cost basis, what we're seeing here is, again, Bitcoin continues to fall closer and closer to that on-chain cost basis. Is your expectation that we're going to hit it at some point? Or how do you look at the relationship between price and this cost basis?
Sure. So this is kind of what we were talking about at the beginning. And also I should reference last week's show, not to just tell people to keep listening to me rambling, but I think, last week we talked about a lot of these different metrics that we'd be looking at to kind of identify like a cyclical bottom. And so because of that, I only included two in this week's, but these are the two kind of most relevant to me personally. I think the broader theme, as we kind of talked about at the beginning, is that all of these metrics are in the lower kind of 10th percentile of, in historical trading values. Now, they aren't at a full reset, which we'll get to in a second. And that's where I'm personally looking to allocate because, maybe you could say I'm a little greedy and I want to try to somewhat time the bottom, or at least the range where Bitcoin has historically bottomed off of these metrics. But, I think for the average person who's just looking to, dollar cost average into BTC, I mean, this is where you really want to ramp that up heavily and start throwing larger allocations into that DCA that you're doing every day or every week or however often that you're doing that. To look at this chart in specific, so this is looking at the short-term holder realized price or cost basis of short-term holders, and the long-term holder realized price or cost basis of long-term holders. So in the kind of pink or red line, that's the short-term holder realized price. In the light blue, that's the long-term holder realized price. What you'll note is that heading into the bear market, well, you'll note a few things. First of all, the short-term holder cost basis is a really important price level we've talked about for a long time on this show. It serves as support in the bull market as well as resistance in the bear. There's some pretty deep psychological ramifications as to why that happens, in my opinion. In the bull run, people don't want to sell at a loss that have just come into the market because the market's just running up over a multi-month period. So that's why you see some selling subside whenever we retest that cost basis. Heading back into the bear, you get these failed underside retests because people just want to look to break even as Bitcoin's going down 40, 50%, and they don't have any type of long-term conviction. Whenever that short-term holder cost basis crosses below the long-term holder cost basis, that's marked a really good, as I put in the newsletter, generational buy opportunity for BTC. So essentially you have capitulation from the short-term holders / short-term holders aging into long-term holders. But the indicator is showing you that the short-term holder realized price crosses below that long-term holder realized price. And that's kind of that buy zone. And then if you want to get a bit more granular, you could even just wait for the confirmation of the cross back above. So what I'd be looking to do is buy once the short-term holder realized price crosses below the long-term holder, and that would put it below that green line at the bottom. That simply means that the short-term holder cost basis has gone below the long-term holder. But you could also just wait for the confirmation of that coming back out of that buy zone, and that's kind of a momentum confirmation, if you will, of us coming out at the bottom. So those are two approaches that you could take, but the one I'm looking to do is just average in heavily if that short-term holder realized price did go below the long-term holder.
Got it. And then if we take a look at the MVRV Z-score, and we also look at things like number of active addresses, what's interesting to me is the MVRV Z-score continues to fall closer and closer to that like green buy zone that we've been talking about, and kind of a continuation of the trend. But what we have seen that's changed, that isn't a continuation of the trend, is the number of active addresses on this 14-day moving average. We've seen that drop. Do you look at kind of directionally, if everything was just continuing the trend, we had 8, 9, 10 weeks of red candles, like you'd be, okay, that's what you would expect. As price goes down, all of the trends continue through kind of this market correction. How do you think of it when you see some continuations of trend like MVRV Z-score, but also some divergent from past trends like active addresses are actually dropping instead of increasing?
Yeah, it's interesting. The way I look at like active addresses is essentially like a proxy for kind of the amount of, as in the definition, the amount of activity on the network. So that's been in a decline since November of last year and never got close to the levels reached in May of last year as well. Actually, the kind of peak for number of active addresses, ironically, was on May 19th, which was the day before we went down 30%, which is like kind of the, peak visual of when the herd is going one way, go the opposite way. But yeah, I mean, this is kind of what you expect in the bear market. You see a lack of exuberance. You see everything kind of cool down. A lot of the quote unquote, visitors or people vacationing into the BTC market leave and disperse as it's not going up only anymore. And you get left with only the hardcore convicted believers. You get a capital transfer back to those market participants, and that concentration of the capital back to those market participants allows for the next drastic run up. In the same way that when those market participants that were buying at the bottom disperse back to all the ones with low conviction at the top, that allows for such a large correction. It goes both ways. And so I think this is just one of those indicators of that kind of cool off and exuberance. Now to get to the MVRV Z-score, as I said, this was in combination with the on-chain cost basis. You could also throw the 200-week moving average in here as well. This is a more these are the more relevant metrics that I'm looking at to allocate the rest of the dry powder that I'm sitting on currently. So this compares the market cap. I mean, sorry, the market value. In this case, we're looking at price and not market cap. So it's the market price to the realized price. Realized price being just the aggregated average cost basis of all the entities on chain based on the last time that coins were moved. As you can see, that red zone kind of signals euphoria or overexuberance in the market. We did tap it, but we didn't get that kind of blow off push through that we were kind of expecting that historically has taken place. But nonetheless, we did hit that overheated zone. And that bottom zone, this green zone, is an indicator that the market price has dropped below the realized price, which currently sits at about 24,000. So if you get market price going below that realized price, then we will enter that green zone at the bottom. And that green zone at the bottom has historically marked kind of generational buy opportunities for BTC. So, on one hand, you probably have some people that say, well, we barely got into that, zone of exuberance at the top, kind of got that rounded top, and we're very close to that bottoming area, getting below that realized price. Maybe it's close enough for you to want to DCA into that. That's, your personal decision, but we are very close. Or you could be in the camp of waiting for that full reset into that green zone, which has historically been kind of a no-brainer buy opportunity.
Got it. And then what about geographic premiums? Like, I know that you said that Asia was putting a premium in the last couple of weeks. Is that still continuing?
Yeah, for sure. So this is looking at the trading hours broken down between Asian, United States, and Europe. And so this compares Asian to the other two. And so what you see is, like, based on this, at least, Asia has kind of dominated the market over the last 2 years or so. You saw them buy the bottom after the COVID crash and sell right before the COVID crash. They sold all the way down into the top in the beginning of 2021. They bought, essentially, they bought the puke from US and Europe at the bottom in the middle of summer of last year, and then dumped back on them on the pump off the lows. They bought that retest of 40K and then sold aggressively in November, the most of which they ever have. And at kind of the end of November into December, bought back in January at that kind of local bottom that we set, sold into the top of the range. And then recently they've been buying again, according to the trading hour premium. And this is the most aggressive increase in the premium that we've seen since summer of last year. So that's super interesting. Another thing is I watch the order books a fair amount, and not like 24/7, but that is something like every few hours I'll go in and just check kind of what's going on. And like myself and a few other traders that I speak with and whatever group chats and things like that, I've noticed there's been this kind of persistent bidder in Binance's order book, which is, of course, an Asian-based exchange. So kind of seeing confluence in the order books as well with what I'm seeing in the trading hour premium.
Got it. And then, Blake, help us understand in terms of the macro environment. Like, what are you seeing that you think is relevant here to Bitcoin?
Yeah. So, I mean, I kind of think the name of the game right now is that we're in this rising interest rate environment. And, the effect of this is mostly initially into the bond market. So interest rates and bond prices have this inverse relationship. And, Bitcoin guys normally don't like to hear about, bond markets, they're boring or whatever, but I think they're super important from an institutional perspective. So essentially, interest rates are rising, so bond prices are falling, which makes yields rise. And, institutions use bond yields to valuate stocks. It kind of helps them form their risk preferences. So when you have these rising yields, bond or stock valuations fall, which makes, kind of scares institutions. So they go towards risk off. So that's why you see, all these tech stocks are falling. We're in a bear market in tech stocks, and that bleeds over into the crypto atmosphere, into the Bitcoin market. So I think just that whole, rising interest rate environment is, super important for, Bitcoin investors and stock investors as well to understand.
Yeah, it's really interesting to kind of see, as Will was talking about, like the correlations and to stock as well. And to understand that probably a lot of people who are speculating on Bitcoin from the Wall Street world that would have this as the riskiest asset in their portfolio, they've likely dumped it at this point. And so it could be a big sign as to why we're getting the bifurcation of correlations, et cetera. Is that kind of how you see it as well?
Yeah, I think so. Like I said, I think it all comes down to risk preferences. So when you start to go risk off, these institutions like in the funds, hedge funds, mutual funds, they treat Bitcoin like a risk asset, right? They treat it like a tech stock. They don't necessarily treat it for, the network effect that, we as, Bitcoiners believe in. So I think that's kind of the name of the game, is just that when the Fed is, trying to slow down the economy, it scares institutions and they want to get out of their Bitcoin.
Yeah, it's it's crazy how simplistic it can be at times, right? Of like just supply, demand, fear, etc. When you start thinking about the quantitative tightening that's occurring, what's your expectation of how Bitcoin gets treated here? Is it just correlations go towards one, and all macro is the overwhelming force, and assets, underlying fundamentals don't matter, or something different?
Yeah, so I think it's kind of hard to say. So, the last quantitative tightening cycle we saw was 2018, 2019, and it was almost, really disastrous for the markets. So the Fed kind of overshot their QT goal, and they almost, crashed the economy. So I think, and today their plan is to be even more aggressive than they were back then. So there you're looking at the last QT cycle, 2018, 2019. And, generally in quantitative tightening, right, they're shrinking their balance sheet. So they're drawing liquidity out of the markets. So what should happen is that the economy slows down and prices fall. But there, if you look at the blue line, like CPI, which is arguably not a great indicator of inflation, but it's the most widely used by institutions. CPI was rising during that environment. So, they overshot their goal and it created, a bunch of issues. The S&P was very close to a bear market. It's down like 19% before they, reversed course and kind of saved stocks and bonds. Today they're planning to be even more aggressive. So I think we'll probably see, open market selling of their bonds. So generally in QT, you're either selling your bonds or you're allowing them to mature. So, if people don't understand bonds, so you buy them for a fixed amount of time, right? So you've heard of the 10-year or the 2-year or whatever. So at the end of the 10 years, your bond matures and you receive the principal. So with the treasury bond, you receive $1,000. So now in a QE environment, which is what we had for the last 2 years, the Fed will take that principal and go buy more bonds. But now in QT, they're just taking that principal, not buying more bonds. So they're shrinking their balance sheet. And then we're also probably going to see them open market selling bonds. So whether this causes, a big spike in yields, I think kind of depends on the liquidity of the bond market and just, how aggressive they actually end up selling their bonds. So I think it's kind of up in the air and how this actually ends up playing out.
Yeah. What's your thought process on their ability to continue to cut rates through the end of the year? Like, will they have to, increase rates at the end of the year? Will they basically have to continue to increase and just push us further and further into a recessionary period and not worry about asset prices? Or do you think that at some point, no, they're actually going to have to, maybe cool off, pause, maybe even reverse course? Like, how do you see this playing out?
Yeah, so I think, the Fed and Powell has said repeatedly, their focus is inflation. They're not as much worried about the stock market, which is kind of a reverse or a change in behavior historically. But, they're also saying we're going to do anything we can to slow inflation. And then 2 minutes later, they say, a 70 basis point hike is off the table, which is just classic, Fed maneuvering. But I think kind of the issue that we have is that, we're in this, fiat system. So since 1971, Nixon severs ties to the gold standard. So now you have this currency where there's nothing, in reality backing it, right? Before you could only have so many dollars because each dollar is worth X amount of gold, and you can't have more dollars than you have gold. But now under this fiat system, the government is allowed to print as much currency as they want, right? And that's what they do. They just print currency to solve their problems. But the issue is, you inflate, the amount of currency out there, and it decreases purchasing power. So what it does is it decentivizes saving in USD, right? The analogy a lot of people use is it's like holding your money in, a melting ice cube of purchasing power. So what that does is it incentivizes people to go and borrow money, right? You take on debt. And if you look at, total outstanding public debt levels, it basically just goes up and to the right. So what happens is, people build more and more debt. And then the Fed, maybe they need to raise interest rates to help slow the economy, bring down prices. But the issue is, there's so much debt out there that people, stop being able to, repay their debt, right? They become insolvent. And here you can see, that's, U.S. public debt as a percentage of GDP. So basically looking at how much debt is there in comparison to economic output. And what you see now is, public debt to GDP is at an all-time high, right? It's even higher than the inflationary period of the 1940s, where the government was paying for the Second World War. So we just see massive amounts of debt in the system. So over time, interest rates, are falling. It makes it even more attractive to take on debt. But the issue is, so the Fed starts to raise interest rates and people are like, whoa, we can't afford this, causes recession, people are defaulting on debt. And the Fed has to, reverse course and bring interest rates back lower. So this kind of repeats over and over and creates these short-term debt cycles, which are, commonly referred to as like the business cycle, 3 to 7 year business cycle. But then eventually you reach this lower limit. So you either have to, increase interest rates to save the economy, or to slow the economy. Then, people are, insolvent. So you have to bring interest rates back down. But then you reach this lower limit where you're essentially stuck between zero and the level where it causes insolvency. And that's kind of where we're at now. So the Fed has said, we're going to raise interest rates at 50 basis points for each, hike or each FOMC meeting, which there's 5 left in the year. So this would put the Fed funds rate at 3 to 3.5% by the end of the year. And the issue is, if you look at the trend of the Fed funds rate over time, once you kind of reach this downtrend, this channel, once you reach the top of it, it creates this insolvency and it causes a recession. So now the Fed's kind of stuck between this rock and a hard place where they either need to raise interest rates to bring down the prices of goods, or they raise interest rates and people default on their debt and causes a recession.
If I could just hop in real quick, I think getting that chart up with the downtrend of the Fed funds rate would be really helpful to kind of illustrate what he's saying, just for listeners' sake.
Do y'all have that one?
We do. We'll pull it up here. When you look at the Fed's fund rate as it's kind of falling here,
there we go.
I mean, just off a cliff, right? Just continuous down, persistent only.
Right. So you can see, it's kind of hard to see on my screen. I think you can see like the gray vertical channels, that those indicate recessionary periods.
Yep.
So what you see is every time the Fed funds rate, so the Fed funds rate is that blue line with the red downtrend line drawn across the top. What you see is every time the Fed funds rate reaches that downtrend line, it's essentially, interest payments are too high for people to afford, and they are insolvent on their debt, and it causes this recession. So if the Fed is really going to bring interest rates to 3 to 3.5%, you're going to be way above that downtrend line. You're going to be even higher, than that last high, that 2018, 2019 peak you can see there. We'd be above that. So it would just create these issues. So what I think, and what a lot of people think, is that the Fed is, jawboning. So they're essentially, the markets are forward looking, right? So if the Fed's saying, yeah, you're going to have a 3% Fed funds rate, the market isn't going to wait until that actually comes to, take action on that. The market's just going to immediately start pricing that information in. So what I think the Fed is doing is they're saying, you're going to get a 3% Fed funds rate so that it gets priced in, and then they don't actually have to do it when the time comes. Yeah.
I mean, my base case here is that they obviously don't get the 10 interest rate hikes. We don't get the 300 basis point interest by the end of the year. But I still am holding out. I think that there's a chance. I'm not saying that for sure it's going to happen, but I do think that there's a chance we get an interest rate cut before the end of the year as like a way to basically instill some confidence back into the market, because they continue to hike rates. There's even just more sell off. At some point they say, oh, we went too far. Let's just give kind of a little check here into the market, which, it wouldn't be the first time they've done that, but still, I don't think people think that's going to happen at this point.
Right. No, I agree. I guess we'll see. I mean, it's kind of anyone's guess at this point.
What's the thing?
I think like one thing that's perhaps maybe a bit different than like 2018, for example, is you started to see the Fed talking about their credibility, right? And I think that's like really interesting now. I think they're almost on like this. Darius said this on the podcast that he was recently on with you. They're almost on this tear to like redeem themselves after they admitted that they made a huge policy mistake over the last 2 years. I think that's just like one interesting thing to keep in mind, that perhaps they're going to just keep pushing this until it breaks, because they're essentially like trying to reclaim their credibility in kind of crushing inflation. So, and you've also seen like Powell started like comparing himself to Volcker, which has been pretty interesting, right? Because obviously like Volcker raised interest rates to like 18%, which was insane, causing like recessions. But I mean, he did crush inflation. But I do think like from like a just human standpoint of like, credibility standpoint, the fact that they're talking about they want to, basically do this to like reclaim their credibility as an entity, I think is like just one interesting thing, I guess, to keep in mind. But sorry to hop in and cut you off.
Well, let me ask one last question and let you guys go. Blake, when you think about kind of the Bitcoin market and macro and the intersection, what's the one thing? Is it just the Fed? That's the thing to watch for the rest of the year? Or are there other things that you're paying attention to?
I pay a lot of attention to the Fed because, like I was talking about earlier, that, spills over directly into the bond market. And then that's kind of the institutional, risk preference. Decision making is based off, the bond market and bond yields. So I kind of think that's the area to watch. And I kind of harp about that in the newsletter and on Twitter and whatnot, that, people need to be watching yields. And as boring as it is, and the bond market isn't as fun as, the Bitcoin market, it's really important because, institutions are generally what drive, stocks to go on massive runs or, other types of assets to go on, big sustainable runs. So it's really important to, keep an eye on institutions, right? There's this quote, when you see, a stock breaking out on big volume, right? That isn't your Aunt Sally buying, right? That's a mutual fund putting $1 billion into a stock or whatever. So it's really important. I think if you're someone who wants to see Bitcoin succeed, you want to watch what the institutions are doing. So I think what the Fed's doing and what the bond market's doing in bond yields is really important to keep an eye on.
Yeah, it's gonna be a wild freaking couple of months. But I appreciate you guys both coming on. Where can we send people to find you guys on the internet?
You can follow me on Twitter, Blake Davis 50. That's me.
There he is.
You got a new profile picture. Looking fresh.
I took that in my backyard selfie timer.
There you go.
I love it. And then Will, what are we at, 636 now?
We're trying to pump up Blake's numbers. I would also say check out the newsletter, of course. Link is in the bio, free. If you liked anything of the two of us rambling today, would love to have some new people checking out the newsletter, get some feedback on it.
Where do we send them? What's the URL?
Oh, we just changed it. I think it's
in both of our
newsletter.blockwareintelligence.com, or it's in both of our bios. And we just also, one other thing for people who are Spanish speaking, we also just integrated. You can now subscribe to a Spanish version of the newsletter. If you go to our website and in the link in my bio, you can also subscribe to that if you're interested in that.
All right, fellas. I appreciate both of you guys coming on. I learn something every single week with Will and Blake. We'll have to bring you back as well as all this continues to play out. But I appreciate it, and we'll have you guys back soon.
Thank you for having me.
Thanks so much, Pomp. Have a great weekend, man.
All right, later, fellas.
Hey, you. Did you like this video? Great. We make 5 of them a day and post them here on this channel. Make sure you're subscribed, like the video, and see you next time.